Good evening, ladies and gentlemen. You're watching the evening news on News Now. Of course, our top focus this hour will be on Q1FY25 GDP figures that are expected to be out soon. So we'll be focusing on that big story. And we'll, of course, be joined by economists to decode the state of the Indian economy at this point. But let's take a quick look at some other stories that are coming in. In fact, we have some breaking inputs coming in. In fact, the GDP for the first quarter of FY25 is out for the month of April to June quarter. GDP growth is at 6.7%. So that's the big breaking we're getting to you as of now. In fact, analysts were estimating 6.9%. Several analysts who've spoken to ET Now were estimating this number to come at 6.9%. That was supposed to be a 5-quarter low, but GDP growth for the first quarter has come in at 6.7%. Remember, Q4 FY24 growth was registered at a stellar 7.8%. The economic survey had projected the growth for FY25 to be in the range of 6.5 to 7%, albeit with a cautious outlook. But that number has come in lower than the economists were expecting. In fact, there will be several risks as far as the economy is concerned. And that was the broader sense that we got, from several economists who we spoke to. And now we're joined by Mr. D.K. Joshi, who's the chief economist at CRISIL, and of course, Mr. Indraneel Pan, who's the chief economist at Yes Bank. Let me come to you first, Mr. Pan. This data has come in lower than what was projected, 6.9% according to what ET Now's poll was suggesting, which was supposed to be a 5-quarter low. But this, even coming in below those kind of expectations, what's really led to that? We do understand that this muted print is on account of elections, the El Nino effect as well. But what else has really been the key triggers?
I think some of the triggers that you have already rightly pointed out. There was obviously a lower from the GDP side and the expenditure side. Obviously, the government's revenue expenditure, both at the center and the state, and the capex expenditure of the government was lower. That is likely to have pulled down the growth numbers to an extent. While we await for the sort of details in terms of the expenditure side as well as the production side, I would be more sort of interested in looking at how the private consumption has behaved, because private consumption was one weak element within the various quarterly GDP numbers that we have seen. And from our early understanding, or from our understanding of the first quarter numbers, there could be a continuing softness in the private consumption expenditure. And that's I think, where I would be looking at very crucially in this GDP number.
All right, so that will be a key factor to watch out for in terms of, how much private investment has been, given that the kind of capex push that we've seen from the government, not just in this budget, but of course in the interim budget as well. On that note, let me come to you, Mr. Joshi. What really are the risks then for the economy going forward? And from this number which is coming at 6.5%, do you really see a resurrection in the next quarter, considering that, the monsoon has been rather decent, and of course it is going to be the festive season? So do we expect some kind of a resurrection? And if yes, what is your estimate on that?
Well, I think, first of all, I think the three factors that led to the decline. So it was slowdown in growth was a foregone conclusion, because we had seen that urban consumption was weakening. The corporate performance has also been tepid. And also, I think on top of that, as Indraneel was mentioning, I think the capex, the central government capex was minus 30% and state government capex minus 19% in the first quarter. So slowdown was very much expected. We were expecting 6.8% growth. Our forecast for the full fiscal year is 6.8%, which essentially means that we expect the growth momentum to be similar in the rest of the quarters. Well, you are right. I think the monsoons are better than they were last year, and there is expectation that that will lift the agriculture production and will also bring food inflation down. So when food inflation comes down, the discretionary spending ability of the households in urban and rural areas improves. And we do expect that the rural economy will do much better than the urban, because urban economy bears the higher brunt of rise in interest rates, whereas the rural economy will benefit from One, from the good monsoons, and second, I think it will also benefit from the government spending, particularly in employment generating and asset creating schemes like PM Awas Yojana for urban as well as rural areas, but it's more focused on the rural areas. So that's going to provide some buffer to consumption. And our overall expectation is that private consumption will do much better than what it did last year when it grew at just 4%, which is a 20-year low if you take the pandemic year out. So overall, I think we do expect the economy to log about 6.8%, which is a pretty decent rate of growth given the global environment and a number of risks. What we still need to watch out is how the monsoons play out in the rest of the season, because excess rain can also damage crops. And in the last few years,
absolutely, and that can have a bearing. That can have a bearing on demand as far as the rural economy is concerned. Of course, Mr. Joshi, but also joining us is now Mr. Jayesh Mehta, who's from DSP Finance. Mr. Mehta, your first thoughts on what these numbers really say about the state of the Indian economy overall in Q1. Of course, the other two guests have spoken about, the headwinds with respect to, election spending, and of course, the El Nino factor coming in, severe heat wave, because of which rural consumption was slow. But what do you make of this number? What do you make of this softness coming in? And would you also call this a temporary blip? Second point that I want to ask as part of this overall question is, how much of an impact do you think this number will have on, the yearly print for the economy?
So actually, as Justice started also, basically the impact was mainly coming from negative spend, capex spend, or negative spend from center as well as state during the first quarter. I think overall expectation was not too away. It was overall expectation was around 6.8. It's come a little bit softer than that, which is okay. And I think with better monsoon, better seasonal, there are seasonal factors also. Hopefully, we would see the next 2 quarters. Maybe even you may see a little bit dippiness in July to September quarter, but the next 2 quarters looks quite promising. So overall, yes, this would be the lowest print, I think, for this financial year 24-25. And maybe we'll start improving from September. And that's where we look at it. We'll still go with an estimate of around 6.9 to 7 kind of a number for the whole financial year. So naturally, we do expect all the next 3 prints to come in higher. That's where the expectation is.
All right. So you're factoring in a 6.9% growth for the full year, and of course that's also the growth that has been mentioned in the economic survey as well. Albeit there was some caution coming in as far as this print is coming in. Of course, that is on the back of global risks that are playing out. We'll come to that point in just a bit, gentlemen. But let me go to Mr. Pan at this point. Mr. Pan, we were also speaking about rural consumption. Of course, there is that kind of optimism playing around the pickup of rural growth on the back of the budgeted capex, deployment, and which is further expected to push private investment as well. But do you think the impact of the capex deployment is yet to kick in? Do you see there is over-optimism as far as the rural economy front is concerned, given the kind of numbers that we've seen from FMCG companies and, of course, auto companies?
I think there are definitely some sort of green shoots in the rural growth story. But having said that, I think as DK also rightly pointed out, there has been some optimism in terms of the agricultural growth. Sowing has been good. And we will have to, however, track the progress of the monsoon in the next, in the remaining part of the southwest monsoon. Having said that, I think the bounce factor in the rural economy may not be that significant, in my opinion. One, beyond agriculture, rural wage growth appears to be quite soft. The real wage growth in the rural sector appears to be quite soft. And the smaller ticket size personal loans, as has been an issue raised by the Reserve Bank of India in its FSR reports, less than 50,000 category loans they probably are sort of showing some amount of stress, which to an extent is also possibly indicative of the indebtedness in the rural segment. So yes, if income levels go up because of the agriculture, a certain portion of that, in my opinion, would also go towards to sort of bringing down the indebtedness of the rural segment, which in effect will possibly sort of reduce the growth potential or the upside in terms of the rural consumption that we have been talking about.
Right, very interesting points that you've mentioned, Mr. Pan. Let me go across to Mr. Joshi and speak about the economic survey, which painted 6.5 to 7% growth picture for FY25. Of course, there is that caution in the air as well. But can the full year outlook, Mr. Joshi, give us surprises if some of the factors like the two wars find some sort of a resolution? What is your view on that?
I think last year was a surprise. If you remember last fiscal, I think the first estimate was 7.3 and the final estimate came out at 8.2% for the overall GDP. So this year can surprise, but I think the risks seem to be fairly balanced, I think between 6.5 to 7%. So our forecast is 6.8, which is the midpoint of that. So I mean, at this juncture, if commodity crude prices come down, that will be a result of weaker global growth. So I think your impetus to exports will come down. So the point I think here is that the upside to growth is very limited at this juncture because there are a number of risks which are simmering, so to say, and escalations. But if I think there is a more benign global environment, then I think there is some possibility, but the probability of that is extremely low right now. And even I think the Fed is likely to move its rate cuts to next month. I mean, earlier it was supposed to do in December. That itself is telling you that there is some weakness emerging there as well. And China is also becoming is showing more weakness than was expected earlier. So I think the global environment is not that great from that perspective. So we could see some softening in crude and commodity prices continue, which is good for us. But the growth we don't see much upside to it. I think the risks are fairly balanced for our 6.8% GDP growth on the upside and the downside.
All right, Mr. Joshi, Mr. Mehta, let me now come to you. Is this number factoring in the kind of risks that we see playing out? And secondly, as part of the risks point, I also want to understand from you. Now, we understand that the overall risk in the capital markets has gone up due to these two conflicts that are brewing in. And of course, how these could then have an impact on India's exports. But globally, there's also chorus building up to bring an end to those two wars in terms of reaching a peace deal. Of course, chorus building up as far as the Ukraine-Russia war is also concerned. I mean, we also saw the Prime Minister going there, and of course, the kind of comments that have come in from Mr. Zelensky and Mr. Putin. What is your view on that?
To me?
Yes, sir.
Sorry. So I think global risk, we have seen a lot of risk. So I think that's more or less panned out. Hopefully, we will look for better news. More than that, I actually am looking more forward to US rate cuts, which hopefully will see some liquidity softening here and maybe rate cut in October, if not October, definitely by December. That should give a little bit boost to that. That's the reason we have a little bit higher expectation on GDP, because yes, we do need to grow, and with 2% real rate, at some point of time, we will need to cut the rate. September, maybe the US cuts the rate. We cut the rate now, maybe I'm hoping October, but if not October, December, definitely we see a rate cut. And more importantly than the rate cut is the liquidity infusion, which we should be seeing. So from that perspective, definitely looks positive. Now, in terms of risk, there is definitely global slowdown, which is happening, particularly China. US, I'm not too sure about it, because if you see their their GDP number yesterday, which came out, is definitely much, much higher than the expectation. So from that perspective, the biggest economy is still growing more relatively stronger than what it is, what normally people feel. So I think from the global side, yes, geopolitical news, geopolitical stuff doesn't look like, but you never know about it. But looks like basically people are more or less done with it.
Right, Mr. Mehta, let me come to you, Mr. Pan, on that point about the expected rate cut in September or October. Now, of course, there is hope coming in on the US economy picking up after that rate cut, and if political stability in the country remains, which basically means that if Democrats once again come to power, that could mean a flight of capital to US economy, is what some experts and some economists have told that. How then is the scenario looking like for India? How do you weigh in on that?
First of all, I'm not as aggressive on rate cuts in the US as a significant portion of the market is, simply because the whole market reaction has been on one single employment data. But if I look at the data from the US subsequently, even the upside that has been provided to the US GDP yesterday, we are of course waiting for one of the very crucial data, the PCE headline and the core today from the US, and the labor market data in the next week. But given the whole sort of scenario, I do not think there is this aggravated risk of a hard landing in the US, which should lead to the US Fed cutting by only 25 basis points. For the Reserve Bank of India, I'm not sure whether they are likely to very strictly follow them. And as Jayesh rightly pointed out, we are not expecting anything in October. Given this growth number that has come out today, which is slightly lower than what the RBI's expectation is, that may also not get a full factoring in the RBI sort of reaction function, because if we are expecting expenditures from the government to go higher, we should see a relatively positive spin on the growth. So 7% growth is a likely sort of scenario continuing from the Reserve Bank's perspective. The 4% central line is yet not met by the Reserve Bank of India. Even the first quarter FY26 is at 4.4%. And recent studies that we have seen from the Reserve Bank of India also point out to the factor that there is a pass-through effect from higher food prices onto inflation expectations. And a restrictive monetary policy has been able to neutralize that in terms of, again, bringing down the core CPI. So I don't think the RBI is likely to be reacting immediately to a US Fed rate cut.
All right. Thank you very much, sir, for joining us, Mr. Mehta, Mr. Joshi, and Mr. Pan, for sharing your thoughts on the state of the Indian economy. And of course, viewers, before we go, let me also give you sector-wise growth rates that are also coming in just now. Agriculture, livestock has improved as well by 3.7%. In fact, mining and quarrying has also improved. Manufacturing as a segment has also seen an improvement. Electricity, gas, that is one sector that's seen the most improvement, along with construction as a sector, and of course the financial, real estate and professional services as a sector that has also seen considerable growth as far as Q1 of FY25 is concerned. Well, that's all that we have on the state of the Indian economy in this segment, but don't go anywhere. We'll be right back with lots more coming up on the other side of this short break.